welcome. It's good to see you again. We just heard from Marko Kolanovic, who's pretty positive still, keeping his positive view on the markets, likes value, likes cyclical, says to buy the dip. Are you as optimistic here about the market and the economy in the face of another severe sell-off today as he is?
It's a matter of time frame here, Sarah. Basically, from our point of view, if you look at it, there's likely to be continued volatility into that March 16th FOMC meeting and beyond. If you had only the Fed to deal with, which you don't, and you have the geopolitical risk, and you have this transition, the psychological transition from growth stocks to value, which we think is quite a durable transition, all of this has caused uncertainty in the markets. So from our point of view, this volatility is likely to persist. We think you get a test of the January lows at 4,200 in the S&P 500. You, in all likelihood, undercut them for a point. But then at some point later towards the middle of the year, we do think the market regains its footing around the narrative that you have durable economic strength and earnings, which ultimately drive stock prices higher.
Do we have durable economic strength in the second half and earnings? There have been a number of negative surprises on the earnings front. We see what happens to stocks when that happens. And there are questions about the sustainability of the recovery, given monetary and fiscal stimulus changing dynamics.
No, there definitely are. And if you think about it, in a lot of ways, when we were worried back in November whether the Fed was going to do enough, now all of a sudden we're worried that the Fed may do too much. The fact that the market has really only essentially sold off sort of mid-single digits is almost in a way quite remarkable. Those overhanging concerns are going to be with us. But from our point of view, again, if you think about it, the preliminary data shows that this Omicron soft patch is exactly that, a soft patch. And we think, when you think about whether it's hotel and leisure stocks really near their highs, confirming that you are going to have this reopening, this reacceleration in the economy. And again, we think that drives earnings.
Julian, I understand that longer term you're bullish equities. I think that's in the DNA of every market strategist out there and is required. But you say that short term you should throw out the notion that cash is trash. What in your view is short term exactly? It sounds like you're playing. You're being very tactical here.
And rightly so. And Melissa, with the VIX, 25, 30, 35. It's very clear that tactics actually do take precedence over strategy in this type of environment. So from our point of view, this is likely to shape up as a tale of two halves. First half of the year, in and around this March 16th hike, continued volatility. Could you trade down below 4,000? Entirely possible. We would note that we did some work that shows the Fed put likely doesn't come into play until 36.70. That's down around 23.8% off the high. But ultimately, the bigger story is you've still got absolutely low rates, negative real yields, and lots of money coming into the market. New generation of investors who've got 40 and 50-year time horizons, they should own stocks, and we think they will buy stocks. And again, it goes back to earning strength, which when we think about 2022 and the potential for reopening, which keeps economic activity elevated into 2023, it sets the table for continued earning strength.